Good morning, folks. Welcome back. Okay, we're going to do some analysis on the current market action on all the pairs that we watch. And then I'm going to go over some of the major points as to what led me to outline the levels as you're seeing in the charts. And the last couple of weeks, we've been pretty spot on with the market direction, certain levels that we've been noting. I've been forcing perspective on you on the daily chart. Some of you, are very appreciative of that now. In fact, I've gotten many emails in the last 48 hours because of the importance of this time frame having made its impression on you finally. Not all of you. I'm not inviting you all to send me an email because I get a lot of emails. It's not necessary. You can just send me a tweet. That would be sufficient enough. But some of you are acknowledging the fact that looking at this time frame and relaxing a little bit, not demanding you to get in there 15-minute time frames and looking for setups and signals every day. This gives you the model on what type of trade you're going to be, because you can see the day trades. You already know what it looks like on the lower time frames. You already know what it looks like to be a one-shot, one-kill trader looking for that weekly range. You don't know how to trade them specifically or consistently, but you can see how they can form using this daily time frame. So I'm encouraged as a mentor to hear that feedback. I really appreciate getting that from a number of you already, and haven't even gotten through all of the content for January. Some of the folks that are in our mentorship, or the two that have voiced their opinion about concerns about whether or not there's any validity or value to this because I spend too much time in hindsight. Again, I can't tell you, any clearer than I've already done using the daily time frame. We're really mapping out what the market's doing. Submission to this daily chart is going to break a lot of your wills. It's either going to make you a better trader or it's going to force you to be reactionary on a lower time frame. And for those that have listened to the instructions about going into this month, it's going to forge a great deal of patience. It's going to force you to look for things that you don't generally look at. That means what the large areas of liquidity are going to be drawing on price. So when we look at daily charts, every single day I've been releasing my specific levels of study, what I'm looking for in terms of the buy side and the sell side liquidity. Some of the questions I've got by email, and I think, if I'm not mistaken, I saw one on Twitter, but it wasn't as clear and distinct as the vocabulary used in the email. It was very direct and said, look, I need to know what's going to happen on the right side of the chart because we're talking too much on the left side. I need to know, what's going on here because I need to know I can trust the guy I'm spending my time and my money on. And, sir, you know who you are, and I'm not trying to, make a case about, any one particular opinion, but I just want you to be realistic about it, okay? When all of you look at the charts and all the analysis and the concepts that I'm employing each week, every time I give you a chart, recently here, it's certainly before 3 p.m. Eastern Standard Time or New York time. So it's in advance. You all have it. And I'm encouraging you to download it so that way there's no changing or editing on my part. I can't change that. Okay, so if I give you the levels on both sides, buy side and sell side liquidity, what should you be doing with that information? So I'm going to clear that up this morning so that way, and I thought this was pretty clear, but apparently some of you don't have an understanding of what it is I'm supposed to be having you do. So I'm going to have that also included today too. So we're going to start with that now. When I give you buy side and sell side liquidity, okay, what you're supposed to be doing is you have a range. It's been defined by me. Now, by default, I'm forcing you to look inside of a specific segment of price action. It's kind of like a bookend, okay? This is the ending point for the upside, and this is the ending point for the downside. And when price is in between these two areas, when I share it on a daily chart, what I'm encouraging you to do is study which side the market's trying to draw to. Imagine, I used to do this a lot when I was in middle school and grade school. I used to play with magnets all the time, and I would invariably take staples out of the paperwork that the teacher would give me, or I'd put little pieces of metallic flake from the shop, because we used to have a wood shop and metal shop, and I would take these little shavings and play with that stuff with the magnet, move the magnet around underneath the desk, and it would move the particles around. Well, price is just like that. Imagine a magnet being up here and a magnet being down here. As the price gets closer to one of these levels, it's going to invariably draw to it. It's going to jump to it. What you're looking for, and you're studying on the daily chart, is there's going to be obvious clues as to which side the market wants to reach for. It's either going to want to reach for the buy side, or it's going to reach for the sell side. This is a skill set that you'll learn, because institutional order flow, there's rules. Okay, there's things that you have to look for. There's fingerprints on how they move price from one level to the next. This exercise, by forcing you, by looking at a daily chart and studying where the buy side liquidity is, or the liquidity pool for buy stops, this is what we're saying here, or the sell side liquidity, or where the sell stops would be, they're pending orders. That's areas where new orders would come in, or existing orders would be executed on. Because we executed on. Because we don't have a real order book, in a sense like what Oanda has, they supposedly, they're showing you their order book, who's net long, who's net short, and where's existing orders. That doesn't really exist, in the sense that it's too vast of a marketplace. It doesn't have a centralized, here's where all the orders are. Okay, so the algorithm knows, by reaching back in time to specific price levels that are very generically defined. There's nothing ambiguous about them. You know, it's the main things we've already talked about. The main thing is old high, old low, because that's the number one thing that everyone's trained to do, is put a buy stop above an old high and a sell stop below an old low. But you've seen this month that there's a great deal of validity to just focusing on this time frame, and by looking at the buy side and sell side liquidity areas that I've noted out, it's not that I'm trying to put out there a bracket of the marketplace and wait for one to get hit and say, now look how smart we are, or specifically me. I'm telling you which side I'm telling you before the fact where it's going. So I'm leading you to where you should be focusing, because I'm trying to reinforce the idea of seeing it pan out over and over again. You're getting a subtle nudge by me. Hey, look, the market's going here. Okay? But this is where the buy side liquidity is. And look, at every time it wants to go up there, does it want to stay in that direction? No. This candle went up, blew out the bodies of these candles over here, even the wick, and then rejected. This candle here, it started to go up. At one point in this day, it looked like a bullish candle. It was engulfing this body's candle here. This candle's body, rather. I always say that backwards. I'm dyslexic when I talk about candlesticks. The body on this candle at one time it opened here and had a full green candle at one time. Then it rejected and went lower and closed lower. So again, my question is, as you're watching each day, instead of opening these charts up and waiting for some kind of little notation saying, okay, we're going to buy here and we're going to look to take our profits here, or this is a new area to sell or anything like that, the idea is for you to get in here and draw up all kinds of notes in the areas that's open. Make notations. Note the fact that it was unable to get up there and hit that area. This up candle didn't even get touched. Then this candle here started bullishly, but look, they couldn't maintain it, and went down below the midpoint or mean threshold of this down candle. So is it indicating its willingness to want to go to these buy side liquidity, or is it indicating that it wants to go down to the sell side liquidity? Clearly, each day it's giving you clues that it wants to go lower. Now, using IPDA, all I'm doing is telling you where the large fund liquidity is. There are shorter term or near term buy and sell stops as well. Even though this is a big area where large funds would have buying interest and selling interest down here, you have these equal bodied candles here. So there's going to be a small liquidity pool of sell stops below here And now this new swing high, because as soon as this candle closes and before this candle starts trading, well, actually when this candle really starts trading, this candle has closed. So now we have a 3-bar pattern or a swing high. So liquidity would be resting right above this high here. But look at the bodies. We wouldn't need to get it all the way up there. All you need is the bodies of each of these candles in here. That represents a period where price was unable to, with a great deal of volume, make a move considerably higher. All it did was make one wick there. So both candles traded here. It opened here, tried to go higher, rejected, and then went down. So there was no real desire to get above this swing high here. This high with a lower high and a lower high here. It only just went above it. Just a brief, small little piercing of this high here and then rejected. By watching the daily chart, it slows things down considerably. And for some of you, that's a blessing because you're trying to make too many decisions throughout the week, which leads to too many trades, which leads to over trading, which leads to hemorrhaging of your equity, even if it's a demo account. So by having these ideas on your chart and me nudging you, telling you, look, I believe that the buy side liquidity is going to be hit here, or I believe that the sell side liquidity is going to be hit here. I believe the range is going to maintain this level but still have a downward draw on price. We're in a larger consolidation. I noted this in the dollar index, but we were leading to this level here. We didn't talk about buy side liquidity. We didn't want to be a buyer up here. The underlying direction was we were bearish dollar. But sideways larger consolidation, what does that mean? That means that we're seeing a steady little drain lower each time, not a massive sell-off where it just keeps blowing through this. We've already seen price trade down below it, and this morning, at one time, it traded right back up to the body of these candles in here. So it's revisiting an old area of support. Now it's going to act as resistance, but now does it have a willingness to go much lower? It hasn't shown it yet. What day of the week is this? It's Tuesday. So there's potential that this could be forming a weekly low. You never know that. You never know that. So you have to look for clues. Just by looking at one chart, you can't come to the conclusion that, okay, the weekly range is forming the low here or the weekly range is forming the high here. You have to build in the ideas of all the other pairs and, like we talked about last night, intermarket analysis. What are the other asset classes and groups telling you what should be taking place? Should there be a larger, longer-term sell-off on the dollar index, or should we be seeing some consolidation or a reversal and resuming of uptrend? All those questions are answered by utilizing all these concepts and tools in concert with one another. So when we look at the daily charts, when I draw up buy side and sell side liquidity, number one, you've already got a predefined range. So don't expect much beyond that right now. Okay, at least don't expect it in the next 24 hours. Some of you get really ambitious about how you think the market's going to trade, and you'll start looking at up here, okay, or you'll look all the way over here, okay, and there's all these other reference points that are closer to you that you have to study. You have to see what influence they have on price. Because I'm going to tell you right now, when you look at charts like this, in hindsight, when we talk about, okay, we talked this was going to be unlikely to be touched, but we were talking about this most likely being touched for the sell side liquidity. When that's discussed in hindsight, it's frustrating to some of you. Because number one, it doesn't equate to a trade. It doesn't equate to profitability. You didn't make any money off of it. And I can't change that perception on it because I've already told you that you're supposed to be learning how to discern where the market's going. Because if you can't get this lesson right, I can tell you all day long entries and exit techniques on any skill set of trading, whether it be short-term, day trading, or scalping, or swing. It's still going to cause you to lose money because you're going to not understand what this particular time frame we studied all this month and still will for the remaining portion of this month has been telling you. Everything that I lead your attention to in this daily time frame will help you in every form of trading, but you have to make the notations, and each day give yourself a little notation. Like, okay, I gave you a chart, you print somewhere. You can type it out, you can go into MS Paint and put it out there yourself, or preferably, this is what I would do. I would print the chart out, and yes, it's going to cost you some money for ink, okay? But who are you investing the money in? I'm not getting that money spent on me. You're spending it on you. It's for your enrichment. So yes, print the charts out. You can print it out in a black and white gray scale. You don't have to use a lot of ink. There's settings on your printer. You can change that. But it's going to cost you a little bit of time to do this each day, and it's going to cost you a little bit of money over and above what you spend for the mentorship. But that's money being spent on you, and it's time that you're spending on yourself. No one else is seeing these notations, and no one else is going to get the benefit of having it. But every single time you see a new candle paint and a new daily chart is updated, you should be noting what you're thinking inside. Literally, write it down. It doesn't have to be a long-winded, explanation about everything you're thinking. What you think right now. I thought that the daily candle at one time today was bullish. I thought it was going to try to make a run for that buy-side liquidity, but it closed lower on the day. So now I have learned that this is a much stronger draw. It showed a willingness to want to not get up there on this candle, and then it confirmed it here. And we're below the middle of this down candle. So it should start making a run for that area over here we shaded in the red. So I should expect to see each day very little upside, and a lot of the candles range be on the downside, and it should stay with a down close. Here's Sunday's opening. Here's Monday's trading. Here we are on Tuesday. Okay. Even on Tuesday today, we've seen the price want to get up, but where's it going to? Just any old random place? No, it's going back to the bodies of the candles over here. And it's showing a willingness to sell off again. So it's finding resistance going higher still, even after it's gone below these lows. But it hasn't broke yesterday's low yet significantly. So we're just in a period of consolidation. It's weighing out whether or not it needs to be down here. In other words, is this justified being below these lows? Now, I like the fact, personally, that we went below here yesterday and we didn't come all the way back and close or trade above this candle's high or Monday's high. I like that, because if we would have done that today, and we still could, I mean, it's still got a little bit of time today, but if it goes right back up and closes above this candle's high, that changes the tune, okay, and now we would then really be looking for a run to the buy side liquidity here. It would be wanting to draw a price up there, okay? Now, using IPDA, the interbank price delivery algorithm, when we have an expectation of what the market should be doing directional wise, okay, that's obviously going to come from a monthly, weekly, daily standpoint. Now, I haven't introduced anything with the monthly and weekly chart yet, but you're going to get that today. We're going to be talking about the monthly P&D arrays, where we map out what the higher time frame charts are doing and where the algorithm will be seeking liquidity based on those ideas. Once you have that monthly and weekly teaching, once that happens, everything we've done so far for the month, it'll gel. You'll know exactly what you're looking for on the higher time frame charts, and after tonight, you'll know what it is that brings you to a daily bias or the weekly range. What direction should that weekly range be? Should it be up or down? And by that, it gives you a plethora of trading signals, because you could be a scalper or day trader or a short-term trader and trade one shot, one kills. When you have the idea of let's just say it like that. When you accept the idea that the market is pushed around by an algorithm, okay, it's sometimes a hard thing to accept, and for some of you, you're struggling. You just don't want to accept it, because I can't prove it to you by saying, okay, here's the proof of it, and here's the programmer of it, and this is where it's centralized, and this is where it's located, and here's the people that work on it when there's issues with it. I can't do any of those things. Okay, I can only tell you by showing you evidences of it before the fact and why it's going to do what it does in price. My only testimony to it is, if it didn't exist, there's no justification for me to be able to do the things I do in the chart. The levels I call, the things that we outlined before the fact, all those things come by way of my understanding of what that algorithm does. And because it repeats itself over and over and over again, to me, that would be enough to convince me. But maybe I'm just, too too gullible, I guess. But nonetheless, when we have our study on a daily time frame, when we involve IPDA data ranges, okay, let's pull up our dividers here. Now this is going to show each month. Each vertical line is a new month, okay? And what we're going to do is we're going to show a range okay? Now this is 60 spaces over, or basically approximately 60 trading days. Now I don't attribute anything to Sundays because I just think Sundays is a partial day. I used to make a lot of case about Sundays being a relevant thing because I wanted to trade every day, and Sundays sometimes gave us a gap, and then that would give me the catapult and all those patterns that we talked about when we were on baby pips. I'm not so concerned about Sundays anymore. In fact, I wish they didn't even exist. I wish they would just start trading on Mondays and not have a weekend day. But it is what it is, and some brokers and some platforms are going to have it, and some of them aren't. And like I said, that's one of the other reasons why, as a mentor, I wish they didn't have it, because it creates so many email questions that I just will answer it here. Just disregard Sunday. Pretend it doesn't exist. Just focus on Monday. There's going to be times where Sunday is going to have an influence, but it's so rare, and it ain't worth it. It ain't worth even considering it. So we have a range of 60 days in here, okay? And what we do is at the beginning of January, which is right in here, the maximum data range is 60 trading days that we look back. So the look back period is seen right there, okay? So now at the beginning of January, as we begin a new month, what we do is we go back and say, okay, what's the furthest back we would look back for liquidity? We look back 60 days, okay? 60 days gives us this range here. So I'm going to add a vertical line. And the vertical line here delineates the marker as far as we go back in time. And I'm going to take the other vertical stuff off, so it kind of clears it up a little bit. The IPDA data range will look back about 60 trading days, and it'll define the range based on that. So what we've already done is we have now a new trading range. We have the highest high was here, because this trading day here is January. This trading day here is December. So we don't have this yet. But looking back, we would go back this far. Okay? So this is the highest high during this whole time before January starts. And this is the lowest low. Okay, so we have a range right there. So 60 days back, this is the low, and this is the high. So this is where the buy side liquidity is on that range, and this is where the sell side liquidity is on that range. Okay. We also have $40 days back. Okay. Now you're probably saying, well, why am I worried about the 40 days if we encapsulate the whole 60 days, doesn't that do the whole thing? No, because I'm going to show you the difference and why it's important to have a 40-day range look back as well. We have this range here. Okay, so from this point of this high, and we have the lowest low would be on this actual candle. This candle's low, so we're going to have to look at that by moving it over and move it over a little bit here. Okay, so we have a new range here. Right there. And there you go. So we have a low here, and we still have that same high here. This is a low inside of that range. So from looking back, before January starts, as soon as December's last trading day occurs and closes, we can immediately go into looking at IPDA. and defining where the liquidity pools are and where the large institutions will draw price. This is the low in the 40-day range, and this is the high. Below these lows in here, sell-side liquidity, where we're actually identifying right now why I just used this level here, why I told you it was going to go to the next level, because I used IPDA's 40-day look back, and it gives us this here. Okay. Now, would we consider this high, even though it's in the range looking back 40 days, would this high be considered? Now, I'm going to ask rhetorically. I'm not looking at questions. I'm just going to assume that you're all nodding your head yes or no. Okay. The question is would you consider this high for IPDA? No, because it's already traded above it. So there's no liquidity here now. It's already been, it's been absorbed. We're looking for highs and lows. Now, this is the low end of the 40-day range, because looking back, this is the 40-day marker right there. So that candle's low is the low end, and then we have this low in here. So we would have sell-side liquidity at that low, which is also, not surprisingly, an old high. See how they line up? You're going to see there's a whole lot of overlapping that you never notice in the charts by doing this. You have a sell-side liquidity resting below these lows here. You can use the wicks, but we like to use the bodies because that's the bulk of the volume. And then the high is here. The next range is the 20. Didn't want to do that. And what I'm doing is I'm drawing it. See that 26, 25, 24, 23, 22, 21, 20. And that's a 20-day range looking back. That takes us right back down to that same area here, so that we have this low, so nothing's changed on the sell side liquidity. So we have this on the 60, 40, and 20, huge liquidity pool resting right there. Okay, so on the sell side liquidity, that's why I've told you the sell side liquidity is right there. It hasn't been gyrating and moving all around. It's staying right there. The whole entire month we've been looking at this particular level right there. The same high is maintained as well. So the buy side liquidity this entire month, has it been reached into? No, it has not. But inside this 20-day range, there's also, with this lowest of the low, we have this low in here, and we have this low when it was created, which went below this one. We have this low. We have this low. Now, think about what it's telling you every single time. Okay, this is what we saw here. Right there. That's the ranges you would have. The 60, the 40, and then you have the 20, which would be right there. So you're looking back to see where the stops are on the buy side and the sell side. Okay, that's just for liquidity pools. You're also doing it for fair value ranges. In other words, going back in the previous order blocks, whether it be bullish or bearish. But you have to have a range to close in. For instance, we have this. This is the last trading day of December, okay? And we haven't started trading in January yet. So looking back 20 days, where's the range? Okay, we have this low, and we have the defined high here, okay? So I'm going to take these little boxes off because I'm not sure if it's distracting you, but it's sure as heck distracting me. I'm going to make sure I can see the price. Let's take, don't want to take the line off. Take that off and take this off and this off. Not that, Michael. And by having that cleaned up, so this is the 60-day. I'll add some graphics on the recording. This is a 60-day look back. This is a 40-day look back, and this is the 20-day look back. We have the low here, okay, and we have the high here. So buy side liquidity is up here, and sell side is as it's been noted all month for January. So buy side liquidity, we have 1, 2, 3 times it tried to get up there. Buy stops will be resting above that. But between this low and this high, what ranges exist? Well, we have 2 of them. We have this range here where it expanded up. So this is a down candle right for the up move. So this is what? This is a bullish order block. Okay, so there's a bullish order block right there. Okay, price comes down, hits it. Is there a response? A little bit. There's the response that goes to the buy side liquidity. Okay, so it hit an area of institutional order flow, bullish order block, inside of the range, inside of the last 20 trading days. So IPDA's going to look, here's the hierarchy in all this. You want to look back in the last 20 days, regardless of what day it is. I'm just using the beginning of January to frame it out. You can start by looking at a market structure shift, okay, or a quarterly shift. Find that most recent one in the last 3 months. You can start there, or you can start at the beginning of the current month you're in. Or if you're in the middle of the month, you want to go back to the previous full month. You can start there. By doing this, it will automatically put you in sync. You can't mess it up because the range is 60 days looking back. It's going to force you to a range of a high and a low, and invariably it's going to show you where the liquidity pools are. All it's doing is giving you a mindset or a framework to work within, looking at how you should go into price, studying where liquidity pools, fair value gaps, and order blocks, which one you should be focusing on right now. By doing that, you'll see that it's very systematic. It continuously gyrates back and forth in these ranges. Excuse me. So the last 60 days, that's the majority of all the working ranges you're going to work with. You don't have to go farther than that many times. Now, if this occurs where you blow out the buy stops and or the sell stops have been blown out, the highest high and the lowest low in the last 60 trading days, if they've both been violated and we're back in the middle of the range, then you just start looking at the ranges on the 40 and the 20. But you still have to identify what the highest high and the lowest low past or to the left of the 60 days would be, because that's going to be the new open float range where the larger liquidity pools will be resting. And it's usually going to be able to find that on a weekly chart. And we'll talk more about that when we get into the discussion on that time frame. But for here, I want you to look, here's 20 days back. This is that order block. It hits it. There's a response. It goes right for the buy stops. Okay, so now you have a new range here. So this can't be here. It's this now. So this is your high, and your low is down here. Right there. Okay, so your IPDA data range is here for 20 days. For 40 days, okay, it's this low down here and still this high. So what you're doing every single trading day, you're looking and see where is price being drawn. So now we have a higher high up here with this high formed with all these lows in here. We have now a new swing low here. So inside the last 20 days, we have sell side liquidity below this low, sell side liquidity below this low, and a larger sell side liquidity pool resting right in here. Watch each day as it forms. Now it closes in the gap here. Buy side liquidity is up here still. Sell side liquidity below this low, sell side liquidity, and again, sell side liquidity below here. It goes and takes the sell side liquidity out. Now, once this has been taken out on this candle here, there's a little bit of responsiveness right there. Boom, it hits it. Is it going to draw for the buy side liquidity? Or is it going to continue for the sell side liquidity? It's in consolidation. It goes up, closes in this little range, which we talked about. It's a gap, in other words. Okay. So in looking back, each trading day, all of these ranges, okay, looking back, they move dynamically forward. Every single new trading day, that's why you want to use like a rectangle, because you can just keep dragging it over one and looking back. And all you're really doing is looking back for the last 60 trading days and defining where the high and the low is. You're looking for any ranges in those last 60 trading days. That means a rally up like this where it creates a void where only buy side delivery on price has been made. Then you find a down candle. That's the one they're going to look to recapitalize. You see it here, even though it's a small little responsiveness on the part of a few days, it still was a nice bounce in there. It created a gap in here. Price came down, cleared out the sell side liquidity here, and then rallied here just to close in this little gap between these two candles here, because there was no buy side delivery. There was no green candles, nothing there. It only opened this candle here and traded down. So nothing was offered on the upside. So price came up and created that gap closure and then sold off. We saw consolidation, but now look, it takes out the sell side liquidity here and here. So what is it? What's the algorithm telling you it wants to do? Is it showing you that it wants to go higher, or is it want to go lower? It's only interested in sell side. So that means what? They're engineering a book that's heavily net short, and they're punishing those that want to buy. It's because they're attacking all logical areas of where sell stops would be. Once the sell side liquidity is taken out below this low here, we have a buy side liquidity pool resting above here, and still the larger one up here. Now, watch. Does price give us any indication that it wants to go to the buy side? No. We have another swing low here. What has it done? It ran that sell side liquidity out. It's reaching for what? This whole entire larger sell side liquidity pool that's been talked about all of January. Price does what? Comes back up, consolidates a little bit, and takes out the buys of these candles in here, which we talked about. We could have seen it trade back up into this order block here, but even when we noted that, it showed us no desire to get up there. Didn't get up there at all. Rejected the interest of getting higher was not there. So where's the sell side liquidity at? Below here and below here. And that's what you're seeing today. So all you're doing is you're looking back 60 trading days to find out where these liquidity pools are, the old highs and old lows, where the order blocks are, where's the ranges, okay? And you're working in that range. You're trying not to spend too much time outside of that range and looking at other things. Keep your focus on that. Now, what's the cast forward? What's the approach to that? Well, when we have a new month, like we do here in January, and I'll change this color a little bit. Okay, so here's January. So what you're doing is once you have this beginning time, okay, it could be like you could start this on February, okay, and you're going to look back from February, go back through January, December, and November, and define the highest high and the lowest low, okay, and that's where large fund liquidity pools are going to be resting. Large liquidity is going to be there. So by having a range of 20 days forward, okay, what you're anticipating is you're going to anticipate a high and a low forming in the next 20 days. Well, here's that new calendar month beginning here, and we're going to put a range of 20. Okay, and what this is doing is it's forcing you to anticipate swing highs and swing lows that form in this 20-day period. Once this occurs, it's going to give you the anticipatory skills to start saying, okay, in this range of the next 20 days, there are long-term trend followers on a fund level that use that range to get into long-term trends. And a perfect example is the turtle traders, okay? I'm not framing on that, but it's just true. Long-term trend following traders use these validations to get in sync with long-term trends. A 20-day break higher when it's a bullish underlying market long-term, that's a very good entry point if you look at it. I mean, it's hard to argue with it. The problem is many times the markets are not poised to go higher, and a breakout above the last 20 days high, many times it's a false breakout and it returns back in the middle of the range or reverses altogether. We can use this insight going forward once we have a delineation that begins this whole count forward, just using the beginning of the month, okay? Once this occurs, you're going to count forward 20 trading days, okay, and in that range, you're going to be focusing on where the swing highs are. When we see a new swing high form, for instance, we had let me scrunch this over a little bit. Yeah, this is the swing high here. We have a swing high here. We have a swing low here. And a swing low is a candle that has a low with a higher low to the right of it and a higher low to the left of it. This wouldn't look like a swing low to many of you that study standard technical analysis because they tell you that you have to have two candles to the left and two candles to the right, and this probably wouldn't be seen as a swing low. It would just be a short-term low of some kind. But to me, the way I define it is any candle that has a lower high on either side of it, 3 candles total, that's a swing high, and a swing low is just the opposite, one candle with a higher low to the left and a higher low to the right. So we have sell side liquidity below this low, and then we have a swing high here, which would be buy stops above here. So sell stops below here and buy stops above here. In the next 20 days, you're going to be looking for where price reaches for that. It trades through it here, takes the buy stops out, then goes down for the sell stops below here. We're still inside this next 20 trading days. Every single time you see a swing high, it's taking that swing high out and then moving lower and running for a swing low. It's occurring in the range of 20 days. Once this occurs, okay, all you're doing is adding another 20 days to this, to 40. What's going to be discovered in your analysis is by having a period of 60 days backwards and 60 days forward, many times you're going to see a quarterly market shift in that 120 days period. You won't see it or expect it unless you start studying it like this, and you'll see it actually materialize real time, and you'll see the mechanics of it all. But the data ranges are just markers on how far to look back for existing liquidity. Looking forward 20 days forward, all you're doing is identifying when there's a new swing high and a new swing low. You're expecting that to be ran out, and you're judging whether or not the market wants to reach for those buy stops or sell stops. And if it's still reaching from one side only, predominantly, it's telling you what the algorithm is pricing in. It's going to go lower. So what does that mean? You go back and you look at the look back period and say, okay, this is where the sell side liquidity pool is here. This is where they're going to be taking price. They're not taking anything out on the upside except for this one here. But every single time a swing low is formed, they keep running that sell stop pull out. It's gone. And you can't gain any new up ground. It's only drifting lower, okay? So for me, I'll tell you what it did for me. It allowed me to frame trend. It allowed me to understand, it's easy. It's written in books all the time, higher high, lower high. I'm sorry, higher high, higher low, okay? Price keeps making higher high, price keeps making a higher low. Okay, so therefore the trend should be higher. That doesn't always occur. It doesn't always occur like that. For instance, you have a low here, price is making higher highs, and you have a higher low. Price makes a higher high and a higher low. And it makes a higher high, and then something happened. What just happened? There's a change in trend there. And I wouldn't be able to see that as a new trader. I would be looking for trend lines and stuff, connecting all that stuff together, and it would be confusing for me. And because I'm very analytical, hyper analytical, I had to find out what would make this stuff be robotic. It had to be stilted. It had to be, because I'm a computer programmer since 6th grade. I was making computer programs when I was 6th grade in my math class. I think like that. I think very binary. And that's why I struggled with trading initially, because I expected it to be on or off, a 1 or a 0. It had to be binary. And for me, when I saw how these orders are introduced in the marketplace, how the markets are taken to a specific level and then taken to another level, okay, that facilitates trade. That means there's control. That means there's artificial intelligence behind it. That means there is a program. That means there is an algorithm. That means there is an element of stiltedness. In other words, it's a program. So if I know how to computer program myself, I can go in and look for the characteristics in price that would give me the validity of these assumptions. And by looking at this, the market didn't prove randomness to me. It proved order. There's no chaos here. There's order in this, but it looks chaotic. And when we look at price through the lens of retail things, it causes chaos, because many times the things that we learn in retail, it goes opposite, or it doesn't do anything at all. The market won't move. It won't bounce bullishly off of a trend line. Or when it goes below the trend line, you should be bearish, but it doesn't do that either. It just stays sideways. Those were the struggling points I had. But when I started looking at these ideas with a 20, 40, and 60-day range, it keeps me focused on what is the price telling me right now. I'm not worried about 6 months from now. I'm not worried about 5 months from now. I'm only looking at what's happened in the last 60 trading days, because that's where the money is right now. 60 trading days, somebody with bigger pockets and more money than me has put real trades in the marketplace. By knowing that, we can see the market has in fact moved higher. All we have to do is know where those lows are, and they're going to make a move on that. The algorithm can't jump unless you're taking a depegging from the Swissy and the Euro into account, or you're doing a Brexit. They don't do these dramatic 1,000-point shifts, okay? They don't do that. The market will logically move to predetermined levels. See, now think about it. In the beginning of January, okay, if there is a computer program If there is an algorithm, I'm going to just suspend the idea for a minute. I'm convinced of it, and you're never going to tell me that it's not. But let's assume there isn't one, okay? How would we go into the marketplace and justify to even consider the idea of it? Okay, we're a skeptic. We're agnostic about it. Okay, we don't know if there is an algorithm. Okay, well, logically, if there's a computer program, how can it know where everybody's order is? If there's no centralized broker or there's no central clearing house for it, okay, not every one of our orders are going into one location, how can an algorithm find everyone's supposed stop? Well, it has to go back in a predefined range. And the way an algorithm is or a program is written in computer language, you have to define a source of data. And because data in the sense of price, it's date and time stamped, and it's a value. It's a high and a low, and there's data points like the open and the close. So all it needs to do is say, okay, I got to go back 60 days ago. 60 days ago is here. What's the highest value in the last 60 days? Well, that's easy. That's down here. And what's the high? This is the lowest low in the last 60 days. And what's the highest high in the last 60 trading days? That's up here. Okay, so there's your defined range. Now, go back 40 days. What's that going to do for the algorithm? It's going to find all of the shorter term highs and lows. Now, if this high is defined in the last 40 trading days, would the algorithm see this as a high of importance? No, because it knows by looking back in the last 40 days, it's gone higher than that. So there wouldn't be any buy stops resting above that. But this low here hasn't been violated in the last 40 or 20 trading days. So therefore, there will be liquidity resting below that. Looking back 20 trading days, the algorithm's going to say, okay, what's the highest high? That's here. What's the lowest low? That's here. What has it done? It's overlapped 2 time periods, 20 and 40. There's going to be a large liquidity pool resting below that. Light bulb moment. Ding, 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 ding. This is your note-taking section, okay? When you have a period at which where 20 and 40 and 60 show an obvious high or low, that's where the market's going. It's going to go there. It's almost a guarantee, a surety that it's going to go there. So if you have this idea, and I showed it to you this entire month of September. I'm sorry, September, good grief, I'm way off of my time. I'm looking at these old months down here. The whole entire month of January, okay, we're in 2017, Michael, get with it. The low that we've identified for sell-side liquidity is always it's been maintained at this level here. We haven't changed our opinion about where the sell-side stops are, where the market's going to draw for the low end. It's down here. The reason why I picked that is what I just explained to you here. Now, that's wonderful, Michael. I get that. I can see it in this chart, and it makes perfect sense to me. But how do I use it going forward? Well, once you have the range defined, and say you create a new higher high, or now we've taken out these bodies on these candles here, but we didn't take out the low yet. So this low still is the one to be watching. Okay, so 99.46. So we're looking for 99.45 to 99.40 for the sell side liquidity, and ultimately price may come back down to this old high back here for some support. Now, what the algorithm will do, okay, what the algorithm will do going forward, it will always look back. Okay, so in other words, when you cast forward 20 trading days, today, if I asked you today's date, obviously everyone should be saying it's January 24th, 2017. So if we were to add 20 trading days or 20 days to that date, we could all logically go to our smartphones probably and pull up what 20 days away from today's date would be. Well, the algorithm can do the same thing. So what it's doing is it's casting forward 20 days, okay, and it creates an artificial look back period from that time right there. And it'll look back through that time and say, okay, where's the high and the low? That's this high here, and now it's this low here. From this moment here, this is the part that's going to confuse you. But when you start doing this on your own and doing it, you'll see exactly what I mean. I can't do it except for do it every single trading day. When we get through the January content, every single trading day that we sit down, we do analysis, I will give you every IPDA data range for the 20, the 40, and 60, and why I say this level is going to be a stop run. This level is going to be the order block it's going to trade into. See, these are the things I just don't talk about. I just do it in my analysis. But I don't literally draw these boxes anymore because I just know where it should be drawn from by quickly looking at the chart and then where my eye goes right to it. Okay, and you'll see what I mean when we start doing February analysis on a daily. We'll be going in here, and every day we'll be back into daily sessions. So that way, you guys that have gone through withdrawal, and you can only take so much of this Tuesday, Thursday live stuff. You want it on a Monday through Friday again. That's what we start doing again in February. So you'll see that if the data range is being applied every single trading day, you'll know what I'm doing, why I'm doing it, and then it'll make a lot more sense to you. But the cast forward, the benefit to that is, number one, you have a predetermined where the 20-day is, and you look back, okay, and as you would look back, you're going to see that this high is where the stops are. This high here is where the stops are, and then you have the low here, the low here, and the low here. Now, this is going to be dynamic. It doesn't stay static on your chart. So every time you have a new higher high or a lower low inside of the last 60 trading days or the last 40 trading days or the last 20 trading days, the data range changes. It shifts just a little bit. That part is the confusion part. And when I looked at the delivery of that teaching, that's the part that is missing, that even when I watched, I said, well, it doesn't answer it for me, because if I was watching this for the first time, it wouldn't make sense to me either. So I understand why the confusion is there. So you're not mad, okay? You're probably mad because you didn't get it, but you're not insane, okay? It's because I didn't do it an adequate job of describing it. But basically, all you're doing is you're in the old days when we didn't have computer programs and charting software like we have here. We literally used to have to circle swing highs and swing lows. We call them ring highs and ring lows. When this was done, you would know where the market structure would be, and you would also see where the stops are. This is like a version of that, just with on steroids, because it's building logic behind the fact that the market's going to draw to these levels to facilitate trade. Now think about it. If the market is controlled by the central bank, they're setting the price every single day. They're moving price up, they're moving price down, and long-term interest rates are drawing price, to a specific level value-wise, fundamentally. But who's in control of the interest rates? The central banks. So that everything is controlled by them. Okay, the data in and the output is controlled by the central bank. So if they are in control of every facet of the information that we use to make decisions to trade with, remove all the other stuff and just focus on, okay, where would it make sense for them to go with price? Where's the majority of the interest at right now? It's below this low. Nothing of interest on the upside up here. They've already priced in a rejection on this high. They've already went above this high here. Every swing low has been violated, and there's nothing down here for support. There's no support down here. But there are orders below that low because they see that as it's a self-fulfilling prophecy that this is a doji of some kind, okay? And therefore, this was a rejection, so therefore, this shouldn't be traded again. But that's where all the sell-side liquidity is, below this low. And then we have all this movement down here taking us down into the low of these candles here. But that's way back. This is outside of the IPDA data range because we've shifted forward now. We're over here. So this delineation for 60 days back is no longer valid. It has to be used from today's date because we made a new low here. We've made a new low inside this 20-day range. We keep making lower lows, and so we have to keep looking back. If you just have a range of 60 days looking back and determining where the highs and the lows are, whether they're short-term or long-term, you'll know where the sell stops are and the buy stops are. And you'll also, your eye will jump right to where those ranges are for the fair value trades for order blocks, like this range here. When it moved lower, it's going to come right back up and close that in. Price is going to be efficiently delivered whether you like it or not. It's going to happen whether we're prepared for it or not, whether we see it coming or not. Until you start doing things like this, you won't think like an algorithm. You won't think like efficient market delivery for price. You won't think about that. You're going to be thinking about patterns. You're going to be thinking about signals and entry techniques and order blocks for the sake of just order blocks up close or down closes, and that's not the answer. The answer is seeing where they want to take price, because there's going to be trades made below that low. Right now, it's just hovering below it, okay? There's going to be trades if it gets up to this level here. They're logical areas where resting pending orders would be right now. By taking price to that level up there, what would it do? It doesn't make any sense to go from where we're at now to there. It doesn't make any sense. Can it do it? Yes. But it doesn't make logical sense right now. It makes logical sense for it to come down and blow out this low. It does make sense to do that because it's already shown an unwillingness to go higher. We went below the bodies of these candles, but it's left this wick. Now, everyone in the room, just for, I'm going to make sure you guys are awake. What is your low? What is your low on December 8th, 2016? What's your quote low for the dollar index? I didn't think about this before I asked. I tell everybody to use this Forex LTD platform because of the dollar index, so you're all giving me the same quote low I got. If this would have been euro, it would have been something different. Nonetheless, the point is you'll see that the low, if we looked at the high on euro, it'll probably be much different. But when we look at the ranges like this, all you're really doing is looking for old highs and old lows, old areas of where the ranges have been created, like this run up in price here, that created a little bit of a liquidity void. Price comes back, draws back down into it, and rallies again. It creates a liquidity void here, runs up, price is only been delivered on the upside. This order block becomes valid. See, a lot of folks they don't know what order block to look at. They don't know how to map out and define an order block. They don't know what a fair value gap is. They don't know what old low or old high the stops are going to be placed above or below and what they would be rating. And when you think like we're defining it here, it helps provide the framework for you to get it. And it's only by you looking at it and seeing it and making notations. And yes, that means sometimes your expectation is going to be opposite to what you see happening in price. But it will give you immediate feedback. That's the point of this whole lesson in January, seeing it happen. And as we do it live going forward every single trading day and every single month remaining in the mentorship, you'll know why I'm logically saying that this is where the sell-side liquidity is, and that's why I think it's going to go here. It won't make sense sometimes when I'm talking about it. You'll have all these ideas that the trend lines are this, or the moving averages are showing you this, or Elliott wave is saying it's the Z wave of, you know, whatever you want to attribute to it. Okay, the bottom line is it's based on the money. Okay, it's based on the money, and by you having this exposure every single trading day in the form of me telling you where the liquidity is and you making notations on your own chart, referring to it every single day, you are teaching yourself to trust what you're seeing in price. And it will repeat itself over and over and over again. You'll know what liquidity pools resting above and below the marketplace define the current range, okay? And by looking at the characteristics of each trading day, what it's doing, it's telling you what it's going to do. It's going where it's most likely being drawn. There's more money below this low than there is above this high. Think about it. What's going on since September? I get to talk about the month I was talking about earlier by mistake. What has happened in the dollar since September 2016? I mean, it's pretty obvious. I mean, the market's gone what? It's gone higher. There's so much money in the dollar being long right now versus how many people are trying to be short dollar. Now, granted, there's somebody that's sold highs in the dollar up here.